my money.
Place your bets, ladies and gentlemen.
Well, some numbers for you tonight. The stock market is off to its worst start to a year since 1939. This indicates that we could be heading towards a bear market after over a decade of positive returns and the record-long bull run market that we are in. Those of you that have been checking your statements recently certainly know the difference in what's happening. But as a refresher for everybody else, we're talking about it here tonight on Money Talks. Understand that a bull market signals rising stock prices and a strong economy, while a bear market signals falling stock prices and possibly a weak economy, and that really is crucial to any type of investor.
So when you're talking about bear and bull markets, the difference lies in the expected outcome. So with the bull market, everyone's expecting the market to rise or your investments to gain value monthly, quarterly, yearly. In a bear market, it's just opposite. The bear market, it's the outlook of the market is more on a negative side, and so you can see drops, huge drops in the value of your portfolio.
There have been 28 bear markets all the way back to 1928. The average decline was 35%, and the average length of time was 289 days, right around 10 months.
Like you look at the people that went through 2008, the ones that stayed consistent and took emotion out of it, those people are sitting pretty right now because the market did so well since that time frame. We've had a couple of down years for sure, but overall they're probably speaking with their advisor or with themselves and saying, hey, I'm glad I stayed consistent.
So if you're wondering if you should try and time the market, Rojo says no. Get in and start putting your money to work.
Long term is your goal. There is no bad time to get in, because at some point in time the work that you're doing now in a down market or volatile market, if you will, it's going to pay huge dividends. You're going to come out looking like a rock star. 5, 10, maybe 15 years down the road, you'll like where you are.
It's called dollar cost averaging, meaning if you are funding a 401k or other type of retirement, when the market and stock prices and or fund prices drop, you are buying on sale. So that when it comes back, and it has 100% of the time, your investment grows with compounding interest.
It all depends on, of course, your time horizon. So if you're in the market for short-term gains, in a bear market, you may not want to be in, right? Because you can have your money in and 2 or 3 days later, you lose 10 to 15% of your value.
And again, just to clarify, a bear market is defined by 20% losses from market highs. And of course, a bull market is 20% increases. The current bull market that started in March of 2009 is now the longest bull market in history. It's topped the bull market off in the 1990s that lasted 113 months. But our current streak is now in jeopardy after the bad start to the year. Time will tell.